Before we get started, just a brief background on Yorkville and who we are. Yorkville is an RIA exclusively focused on investing in U.S. energy infrastructure through MLPs. The firm's principals, including Darren, are pioneers in the MLP asset class and are widely regarded as experts in the field. Most recently, the firm was credited as a top-performing U.S. equity manager by Pensions and Investments magazine, having produced the fourth best 5-year performance out of more than 1,700 different managers. Now, very quick overview on MLPs for those of you who are just getting yourselves acquainted with the asset class. MLPs, or Master Limited Partnerships, as they're more formally known, hold assets that fall under the general scope of energy infrastructure. This includes oil pipelines, storage facilities, gas processing plants, and more. MLPs, as their name suggests, are structured as partnerships for tax purposes, but are traded on public exchanges such as New York Stock Exchange and NASDAQ, as are any other stock. Generally speaking, MLPs have their assets leased under long-term contracts, and they have very little to, in some cases, no notable commodity exposure. So effectively what this means, because of the length of the contracts in place and the different exposures, MLPs are different from your generic energy investment, They're ultimately volume-based and are often considered to be the toll roads of the energy space. With that brief introduction, I'll be turning the call over to Darren and Paul. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box you'll see in the bottom right corner of your screen. We will hold a Q&A session at the end of the call, and we'll do our best to answer everyone's question. With that, I will turn the call over to Darren.
Thank you, Will, and thank you all for joining us for today's call on optimizing your MLP portfolio through distribution growth. I'm going to share a lot about what Yorkville has learned over 20 years of successfully researching and investing in MLPs and why distribution growth is the cornerstone to the MLP investment thesis. To Will's point, MLPs are a different, not only asset class, but a different structure. They're not energy companies. And when you look at our first point here, why invest in MLPs now, you look at energy equities relative to MLPs since 2000. Number one, the big difference between MLPs relative to energy stocks is MLPs have produced 1,000% returns, or 10x return on your money, versus 2.7 times return for the S&P 500 energy. And the reason for that, as we'll discuss more on the conference call, is that, number one, the growth is driven by the growth of distributions over time. And just like this chart shows, the growth of distributions has been consistent and growing over time. So again, if it was tied to commodity price, you'd expect a lot more volatility in distributions over time, which the asset class does not deliver. Looking at energy equity performance since crude oil prices, again, this is part of our bespoke research. We took a look at how do MLPs perform relative to energy prices, and what we're looking at here is the most recent downturn in oil that happened last summer through current. As you can see, MLPs are down. They're the top line, down 6.3%. Energy stocks, as measured by the S&P 500 energy sector, are down 21%, and exploration and production companies are down by 40%. So with MLPs, you have less downside risk or downside capture relative to other energy companies. And again, it's a different business model that delivers less volatility in fundamentals, and as a result, not only produces better upside, but better downside protection as well. So planting a seed here, MLPs may be a nice way of upgrading the quality of your energy exposure across your portfolio. If you're invested in other energy sectors, switching to MLPs, it may not be a bad idea for your clients looking to reduce risk overall in the portfolio. Everything that Yorkville does is focused on fundamentals. We're a research shop. We look at things from the bottom up. If you look at MLP, the next slide looks at MLP distributions relative to earnings of energy companies, relative to the price of oil. So it's a busy chart. Let's take a moment to look at it. The dotted line going through the chart is the price of oil. And then the two bars, the green bars, represents your MLP distributions, and your gray bar represents your earnings from energy companies. Let's focus on this chart here, the period of 2007 through 2009. As we can see from the price of oil, the line going through the chart, it peaked at over $140 per barrel. Dropped in a Great Recession in 2008 and then recovered. What happened with energy earnings, they pretty much follow. You can see the energy earnings, the gray line peaked in 2008, and then in 2009 dramatically dropped off. Clearly the business model for energy is volume multiplied by the price of the commodity equals our revenue, which equals our earnings. In MLPs, you see a very different fundamental picture. Earnings didn't ramp as rapidly with oil. They consistently continued to grow from 2004 through 2008. Oil dropped off in 2009. MLP earnings were essentially flat. In fact, 75% of all partnerships maintained or increased their distributions during the downturn. And then in 2010, you had a new record level of earnings, and we've had record level of distributable cash flow being produced from MLPs every year since 2010. But overall, from 2004 through 2014, stable and growing distributions is what MLPs produce. Again, because it's a different business model. It's leasing capacity, not tied to volumetric risk or not tied to commodity risk. The further part of our analysis here, and just helping us to gain a better understanding of the way MLPs work, and as Will mentioned earlier, all Yorkville does is focus on MLP investing. That's all we do. And part of the research that we do is helping us to understand the asset class better so that we can communicate it with our investors. If you look at the top 10 oil declines since 2000, the average performance of MLPs, you can see that in the left side of the chart, oil has dropped on average 37% in major corrections or dislocations. Peak to trough for MLPs over that same period of time, 5.3%. Mirrors what we discussed a couple of graphs ago. So on the downside, very low correlation between the price of MLPs and the price of the commodity, because there's very low fundamental correlation between MLPs distributions, the cash we receive as investors, and the price of the commodity. So you have a very low downside capture ratio. On the flip side, 360 days post the trough, the price of oil has increased on average over these 10 periods almost by 37%, and MLPs are up 27%. So MLPs are capturing the majority of the upside of a move in commodity price and very little of the downside, which if you look at an investment, what a wonderful combination. Downside protection, not participating in the downside, but you're capturing the majority of the upside. Energy MLPs have low correlation to oil. You can see the dislocation currently that's taking place in the market, and this is a big reason. And if I use dislocation a lot from this point going forward, it's because this is what we see. We've seen a spike in the correlation between MLP performance, which has gone down with oil prices, but fundamentals have remained strong across the asset class. So in the last 12 months, you've had a correlation between MLPs and oil of 0.7, and let me just explain that. A correlation of 1 means it moves perfectly together. If something goes up 10%, it goes up 10%. If it drops 10%, it drops 10%. That would be a correlation of 1. So correlation of 0.7, 70% of the movement in oil is reflected in the price of MLPs. Historically, MLPs have had a 0.3 or 30% of the returns of MLPs have been explained by commodity price. That's a very low correlation. So during this current dislocation, what this slide is telling us and what we're conveying to you is that even if oil prices don't rebound from here, and they have rebounded into the high 50s, low 60s currently, MLPs, just to return to a normal relationship with oil, could continue their upward movement. Another great opportunity that this dislocation between the fundamentals and the price of MLPs is presenting you with and all investors with today. When people ask me, what's one of the primary benefits of MLPs as an investment? A lot of people would say the income it produces, which is absolutely wonderful, or the performance. My first reaction would be the benefits of diversification. MLPs are a distinct asset class, and why do we say that? For this reason here, correlation. When you look at MLPs relative to any other equity, whether it's the S&P 500, REITs, or utilities, you see a correlation that's very low. Anything under half is a very low correlation. So relative to equities, 0.42, relative to REITs, 0.3, relative to utilities, 0.4. What's more important from an asset allocation standpoint, you add MLPs to a portfolio, they're going to lower the overall risk or standard deviation in the portfolio. We saw before they're delivering outsized performance or returns. They're going to lower the risk, and they're going to enhance the returns of an overall portfolio as well as increase the income. So portfolio diversification, one of the primary reasons why you want to add MLPs to a well-diversified portfolio. And today, in a moment, we're going to talk about why, if you're going to add MLP exposure, you made that decision, why you want to optimize that exposure by focusing on growth MLPs. Price dislocation provides good entry points, and depending on the period, it may even be great entry points. And 08 was a great entry point for the asset class. You saw a dislocation where MLPs, not the fundamentals, remember earnings 08, 09, or distributions in MLPs were essentially flat, but MLPs pulled back from a price perspective 39%, in line basically with the S&P 500, not based on fundamentals, but in sympathy with the rest of the market. And what the market realized midway, you had a yield rally. Yields on MLPs popped over 10% across the asset class. So that's a yield rally. And what you saw here is in 2009, investors realized, boy, most of these MLPs have maintained their distribution. Many of them are increasing distributions in the Great Recession. Yields are high. I'm going to get back in. This is a wonderful entry point. You can see that MLPs rallied 80% in 2009, so they made back their losses in 1 year. Our argument is MLPs currently have underperformed the broader markets last year so far through the beginning of 2015. So the relative underperformance of MLPs, not based on fundamentals, but based on price, is another reason why it's a good time to consider adding MLPs or increasing your allocation to MLPs currently. When we've gone through this presentation, people who have listened to it said this is the most important slide that I'm going to talk on today, so take some time with it. And in current valuation, is supportive of superior returns right now in the asset class. So again, MLPs prices have pulled back. They've actually been under pressure for 2016, the first half of 2016 or through mid-June. Fundamentals have maintained strong. Yields have increased as a result. So what we have right now, looking at this chart, is right in the middle. This is the MLP 10-year spread relative to treasuries. Between 350 and 525, MLPs right now are yielding 390 basis points above treasury. So right in this, in the middle of this chart, when MLPs have been at this spot on a relative basis, across their history, they've produced returns in the mid-20s thereafter. So, and kind of branching out from where we find ourselves today, there's a little more of a story that's being told here. As you can see, the bars really shrink after this. They're very little. The MLPs don't often trade any cheaper than where we are right now. You don't often see them at spreads of 500 to 700 or greater than 700. Very few instances in their history have they traded at these valuations. When they have, look at the returns. The gold boxes are showing you the returns when MLPs traded those valuation levels or those spreads. So to the right of where we are right now is when MLPs are even cheaper, larger spreads, greater returns in the next 12 months, and when they trade to the left of it, spreads compress relative to treasuries, meaning MLPs are getting more expensive. And look what's happening with the gold dots. Gold dots are moving down. When MLPs are more expensive, the returns are muted over the next 12 months. So where we are right now, another reason supporting why get into MLPs currently is the current valuation. The spreads are supportive of superior returns going forward. We've spoken a little bit on the fundamentals, or at least how important fundamentals are to Yorkville as a pioneer of investing in master limited partnerships. We created 2 scores to help our clients and allocators stay on top of MLPs from a fundamental standpoint, to monitor and make sure that the story, the investment thesis underpinning MLPs remains in place. And the 2 scores are the Yorkville Stability Score and the Yorkville Growth Score, and they mirror the way we invest in all of our strategies, the investment objective of all of our strategies. One is quality of income, and number 2 is growth of income. And so the way we measure stability here is the stability score says what percentage of MLPs cut their distributions. And in fact, what the stability score measures is just the opposite, is what percentage of MLPs maintained or increased their distributions. And this is across the entire asset class. A score of 10 would mean 100% of all MLPs maintained or increased their distributions. So the current score of 8.8, again, across the entire asset class, means 88% of all MLPs in the most recent quarter maintained or increased their distribution. So that's high quality. Only 12% of the partnerships cut distributions or in the most recent quarter. The growth score is showing 2% currently. That is at the low end of the historical growth of MLPs. Generally 4 to 6% is where we've seen the growth rate. There's 2 sectors that have accounted for 100% of the cuts. So virtually all the cuts have come out of 2 sectors. They've come out of natural resources, some of your coal plays. They've come out of your exploration and production companies. So your infrastructure names within the MLP space have shown stability scores of 10%, and they've shown growth rates of 10% as well. So a very healthy fundamental story, which is what we're most concerned about, because we view MLPs as a strategic asset allocation within a portfolio. Given its low correlation to oil, not a great way to play movements in the price of oil, but a great way to increase the income that a portfolio is giving or producing, decrease the volatility, and if the growth continues to materialize, hopefully continuing to produce the type of returns that it's done on a historical basis. The macro perspective, I'm going to move through this relatively quickly. We did want to touch on, because we're getting a lot of questions on what's going on with oil. Short-term oil is a good indication of the direction MLPs will move. So there's a high correlation, as we demonstrated earlier. It's jumped to 0.7 from 0.3 on a historical basis. When oil shocks happen, MLPs tend to sell off a little bit. So we are cognizant of oil. Currently, globally, the world's in an oversupply situation. There's a number of different statistics that you can pull. We've used EIA's data here. It's roughly 1 million barrels of surplus on a global basis. So less than 1%, basically, or around 1% of an oversupply situation. The world is growing at 1.5 million barrels per day, the consumption on a global basis. So this oversupply, if nothing happened and growth continued at a regular basis, would be taken care of in less than a year. Other factors have come into play. You can see in the United States, rig counts have declined dramatically. This is on the supply side. Rig counts are generally a good predictor of where future oil production is going to come in. So we've seen rig counts decline by 60% precipitously. We saw something very similar in 2008. And if you look at the chart, rig counts are basically on an absolute basis trading where they were in 2008. I think anyone who's lived through 2008, which I'm sure it's pretty much everyone on this call, will realize that right now does not feel like 2008. It's got a different vibe to it, but it's certainly not 2008. So the U.S. has responded rapidly with a cut in rig count than what we would anticipate, although production is at record levels right now in the United States, that it flattens turns down slightly. Not significantly, but just, again, halts growth based on the decline in rig counts. One more point, this slide is super bullish, and this is the long-term macro thesis underpinning MLPs right now. MLPs are the energy highway within the United States, and a partner of mine says they're really the veins and arteries of the U.S. economic system. So production increasing, volumes we're going to need a lot more transportation and infrastructure built out to handle this flow of energy throughout the United States, and ultimately to, as we start exporting LNG to other destinations in the world. So production at 9.5 million, this is 3 million barrels of increase over the past 3 years. That 3 million barrels represents the entire amount of global production increase. Estimates are the United States, this is the macro thesis again, will be producing 16 million barrels of oil. Will be the largest energy producer on a global basis. So again, volume that supports the macro thesis behind an investment in MLPs today. And in our over 60 years combined experience of investing in the asset class, we've never had a macro backdrop like this. Clearly, since we've been in it from the mid-'80s to current, oil production in the United States has been trending downward. So, cutting to the chase here, hopefully we've given you some good reasons why the dislocation in performance of MLPs relative to fundamentals and has produced a good entry point. Top among that list is valuation is very supportive of superior returns going forward. If you've decided that this looks interesting to get into MLPs, let's talk about why distribution growth is the optimal exposure and the best way to, we believe, to invest in MLPs. The power of distribution growth, it drives total returns, number one, and this is an equation we like to look at and use because it works for all asset classes, and it's also simple. You take your current income plus your growth of income plus your price appreciation equals your total return, and your growth of income touches on all aspects of this equation. Growth of income will increase your current income over time, and growth of income drives price appreciation going forward. So when we focus on growth of income here is the primary investment thesis behind MLPs as a firm, it's for good reason because it touches all aspects of total return, and we'll later show you what we think the total return potential of growth MLPs is relative to the broader market, or more beta exposure as we like to call it. The primary benefits of distribution growth, fourfold. Number one, it's protection against rising interest rates. Number two, it's a hedge against inflation. Number three, it produces higher quality income. And number four, faster growing MLPs produce greater total returns. When we analyzed historically, breaking down the asset class, and I don't think you'll see this research done anywhere else but from Yorkville, we looked at and segmented MLPs according to their growth quintiles, and we just put the top and bottom here because we are doing this for illustrative purposes, and the illustration is this. To the right are the fastest growing MLPs, and they produce the highest returns. And to the left are the slowest growing MLPs that have actually shrunk distributions over the past 3 years, and they've produced negative returns. And what's interesting, the market in MLPs is so efficient that the ones that are growing a little bit produce slight returns, a little more growth, a little more returns, until you get to your fastest growing MLPs are producing the highest total returns. When you look at MLPs, and this has been Yorkville's investment thesis in the asset class from the beginning, income is great, current income is great, we love it, but the majority of the return out of MLPs comes from price appreciation. MLPs should be viewed at, in our opinion, as a total return investment. Income is great, again, we'll take it, high quality income and growing income, but at the end of the day, growth of income is more important because it drives price appreciation. The majority of the return from MLPs comes from price appreciation. So again, this slide here is showing faster growing MLPs produce higher total returns. The comparison of our strategy here, the Yorkville MLP Distribution Growth Leaders Liquid Index. This is the strategy here. It's a rules-based investment strategy that YGRO is tracking, and Paul will talk about the security in a moment, or the exchange traded note. YGRO, the Distribution Growth Leaders Index, again, how do we stack up on a fundamental basis relative to the broader MLP marketplace? Well, In the most recent quarter, again, the Alarian MLP index grew at 7.4%. That was the distribution growth. The distribution growth out of the distribution growth leaders was 17.1%, 2.3 times greater distribution growth. Remember the previous slide. What you're looking at there is faster growing MLPs produce superior total returns. So relative to the market here, our rules-based investment strategy is producing 2.3 times the growth rate in distributions relative to the broader market. Finally, well, here coming to the end, the power of distribution growth. This goes to the quality of distribution growth. The Alarian MLP index has produced a stability score of 9.2, so 92% of the names within the Alarian index maintained or increased distributions. And again, one of our first investment objective is the quality of income. 100% of the names in the Yorkville MLP Distribution Growth Leaders Index maintain or increase their distributions. That will be one of the objectives of the strategy going forward. Again, a best-of-breed MLP experience, never delivering across the portfolio, a portfolio that is consistently growing its MLPs period over period. So distribution growth leaders, again, a stability score of 10, 100% of the names maintained or increased distributions. The question that arises often is, well, what are we giving up for distribution growth? Are you having to go into riskier segments of the asset class? Well, number one, fundamentally, would be 100% of the names maintained or increased their distribution. So based on fundamentals, we clearly haven't taken on any more risk or greater volatility. When you look at this next slide in the portfolio, 96% of the portfolio is, or the index, is in infrastructure with only 4% commodity exposure. And then the next question is, well, are you moving down in market capitalization? Am I getting more small cap names? In fact, no. This is large cap exposure. This is large cap growth exposure. The MLP asset class is a highly liquid index we created for institutional investors to be able to take large pieces down within a given day. And Paul will talk more on liquidity during his prepared remarks. So the market cap, you can see 77% of it is large. 23% is mid-cap, so no small cap names within the index. So you're not fundamentally taking on any more risk. You're not moving into riskier segments of the asset class. It's still in infrastructure, nor are you moving downstream into smaller names to pick up greater growth. How does all this translate? The power of distribution growth, again, is superior performance. So we're looking at returns here of the index from June 30th, 2008 to present. Relative to the Alarian MLP index, distribution growth leaders have produced 16.7% annual returns versus 13.2, so 3.5% annually more performance. And as we all know, the power of compounding over this period of time, you'd end up with over 50% more money or greater returns from the investing in Y Grow, which mirrors this index, than you would have in other just beta exposure of MLP. So here we go again, looking at the growth of the Alarian MLP index. We just looked at performance, and why is that again? Growth at 7.4% for Alarian versus 17.1% for the distribution growth leaders. Clearly, again, 2 times greater growth. Fundamentals are supporting the investment thesis. And going back to our back-of-the-envelope calculation, what's the total return potential going forward? A great way of looking at, one of the ways we look at investments is what's our current yield. Current yield plus our distribution growth gives us the total return potential. So current yield 5.4% on the index, distribution growth is 20%, total return potential of 25.8%. So again, optimizing your exposure in MLPs, distribution growth underpins the entire total return investment thesis of MLPs.